Okay, so you should be able to see my slides now. I am going to not use that slide. So I'm going to use, I said a minute ago, I'm going to use the book slides for this class, for this chapter. I do have some things I'm going to show you outside these slides, so I'm hoping I can get through all the slides in the first 2 lectures, and then I've got some Excel work we'll do together in hopefully for the 3rd class. We'll see how fast we move. But I will be using the book slides. These are available to you in the module. There's a module with all of the chapter PowerPoints from the book. So these are provided by the publisher. So I will be lecturing off of this today. I don't usually do this, but there's just a lot of kind of tedious detail that would have involved me writing a lot of this stuff down again. So we'll just run through this. And hopefully it'll be useful. So, okay, so chapter 17 is we're kind of returning back to chapters 3 and 4 because we're going back to a lot of the financial statements. So we're going to be working a lot with the income statement and the balance sheet, and then a little bit with the cash flow. I'm going to be, on the exam, I will most likely be giving you a income statement and a balance sheet and asking you to calculate these ratios from that. And then I will be asking you to, more importantly, because that's just a mechanical process, more importantly, I will be asking you to interpret the meaning of the ratios, which is the point of the ratios. So, or I may give you some ratios and ask you to interpret them and tell me what they tell you about the organization concerned. So this we've done a few financial ratios in chapters 3 and 4. So we did stuff like profit margin, operating margin, debt ratio, current ratio, some of those things. There are just a boatload of other ratios, and I'm going to give you a rapid exposure to some of them. It's going to be important for you to read the textbook, particularly this time around, to familiarize yourself with which ratio would be the appropriate ratio, because I may ask you to come with the appropriate ratio to tell me something about the financial health of an organization. So I may not say calculate the debt ratio, for example, or days cash on hand. I might say, give me 2 appropriate liquidity ratios that would tell me that tell you something about this organization's ability to meet its short-term obligations. And then you'll go and figure out, okay, well, he probably wants, current ratio and days cash on hand, something like that. So you need to be studying the book and understanding these ratios for the exam, but more importantly, you actually need to understand these things because they are used all the time in the real world. And this material I actually teach in a physician leadership course that we run, that I help build here at UNH. And a lot of the folks, the physician leaders that come to this training, sit on board meetings, and they discuss this every month in a board, right? And they don't really understand it. So, a lot of them come and realize, oh, wow, so this is what they've been talking about. So it's important stuff. It's used all the time, and it's important for you to understand it. It's also going to be important for you to understand this for your senior year as we go into planning as well as capstone. So you will need these again. So don't throw them away. Hang on to this information. Hang on to your textbook for sure. Okay, so we're going to be doing financial condition analysis. As part of it, we will be doing financial ratios as well as operating ratios. So So kind of quick overview here. Financial condition analysis includes a couple of different techniques. So we'll be looking at things that are specifically involved with the financial statements. So you'll be able to get all of the data that you need from the financial statements. So you'll be able to go and you'll look at the income statement. You'll go and you'll look at the other statements, the balance sheet, the cash flows, and you can calculate all that. And that allows you to tell where the organization, how the organization's condition is in terms of finances. Then we will combine, the other aspect here is we will combine with the financial data, we will combine operating data. So things like bed days or number of visits or number of FTEs or FTEs full-time equivalents, which is how we measure manpower. And that's an important point, right? So like when we talk about manpower in a hospital, we might have 2 part-time nurses, right? So maybe we've got 2 nurses that will each work 20 hours. Well, if you add 20 and 20 together, that's 40 hours. So that an FTE would be a 40-hour employee. Typically, there's some adjustments there, but typically an FTE is a 40-hour per week employee. So if I have 2 part-time employees, I may have 2 employees, but 1 FTE. So you'll hear that FTE talk a lot in healthcare because we have a lot of people who work part FTEs. Good example of this is over at Core Physicians over at Exeter, the physician group associated with Exeter Hospital. A lot of the physicians are part FTEs, so they sign up for a half an FTE or 3/4 of an FTE or 0.8 of an FTE, right? Because a lot of them are women, to be frank, and they don't want to work full time because they have young children. So that's a common thing that you'll deal with, particularly if, say, you get into practice management. But you'll definitely deal with it if you're on the hospital side. You'll deal with it with nursing staff, and that's probably the most common. So what we'll combine, so coming back to this idea of operating indicators, is we'll look at things like what's our average cost per discharge, right? What is our average cost per visit? Those are operating indicators that we want to track as well. And we've talked about some of that stuff in chapters 5 through 8. But here we'll be looking at it more carefully. So we've got we're going to use this nominal hospital, Riverside Memorial Hospital. So this is a made-up hospital. So this is all fake data. The next couple of slides a lot of this is going to be review, and it is intended to be review. So we haven't talked about financial statements all that much in the last several weeks. So I'm going to kind of spend a little bit of time refreshing you because you will be seeing financial statements again for this chapter. And I keep meaning to move this chapter to like right after chapter 4. I may do that at some point so that because this data is so reliant on the financial accounting that we do earlier in the semester. But as it is, we're going to do a little bit of review. So this is the income statement for this nominal Riverside Memorial Hospital. And remember, the income statement has 3 sections. So the first section is operating revenue. And so they've got a very simplified operating revenue section here where they're just showing you the net patient service revenue, which you're going to refer to as NPSR when you get out into the field, and then other revenue. So this is a hospital. So net patient service revenue would be their natural kind of top line. The bulk of their revenues are going to come in from taking care of patients. And this is going to be net of right? Contractual allowances, which is, so you have the hospital is going to send out charges based on their charge master, which we've discussed is basically like monopoly money. They're going to send out these charges. They're going to say, okay, your surgery was $25,000, right? And then your insurance company is going to come back and say, per our negotiations, we only pay you 50 cents on the dollar. So your $25,000 surgery is actually going to be $12,500. Or they may say, we've negotiated with you in the past that this particular type of surgery, we will pay you $10,000. So that's another way that they could do it. So it's either they may have negotiated, insurance companies will have either negotiated a discount to charges, or they will have negotiated a preset payment for particular types of care. So we might have, they would have a gross charges line, which represents what they build out based on the charge master. Then they would have an allowance for contractual adjustments, right? Which is where they account for all the discounts that they're giving to insurance companies, as well as charity care, right? Because that gets kind of plugged in next. So hospitals all have, not-for-profit hospitals in particular, but even for-profit hospitals provide charity care. So if you were to look at the books for Portsmouth Regional Hospital, which is an HCA entity, they would have a line for charity care that they gave out. And charity care, remember, is not care. Well, so you have charity care, and then you have allowance for doubtful accounts, right, or bad debt. So the difference between charity care and bad debt, right? So you have these are other decrements from your gross revenue. So the difference between charity care and doubtful accounts is with charity care, your analysis is that the patient would not be able to pay for their care. And chances are that's because they're uninsured, right? And they're poor. So they come in, they get the care, and then they meet with your financial managers and they prove to your financial managers, yeah, I'm unemployed and uninsured, so there's no way I'm ever going to be able to pay you, at which point you declare that their care to be charity care, and you just write it off, and you reduce your overall net patient service revenue. The difference between charity care and bad debt is a patient comes in, they have the means to pay for, they may not be insured, but based on your finance people's analysis, they have the ability to pay and they just don't, right? And so that becomes bad debt. And we always know that there's a certain amount of bad debt that's going to happen, right? And this all happens, these things happen because we run on an accrual basis. So when people come in to get their care, they don't write a check, right, at the time that they get their care. We bill them for their care, and they pay after the fact. And so people, you don't write a check on your way into the emergency department. You get billed after the fact. And so that's how bad debt comes about. So this top section is that first third. It's a very abbreviated version of what we did in chapter 3, right? But it is the operating revenue. They're just referring to it as total revenue at this point, which I think is a bit of a inappropriate line. This really ought to be, let me just change it because I can't. This really ought to be operating revenue. So, so this is your revenue from operations. And you have that other revenue, right? We've talked about what goes in other revenue. Well, it's things like cafeteria sales. If you have a parking lot where you charge for parking, like all the Boston hospitals have very expensive parking lots. I don't recommend going there if you're not a patient or the family member of a patient and parking in their parking lots. I did that once because I was doing an interview with the CEO of Mass Ioneer, and parked in their parking lot, and I wound up paying like $60 in parking fees for like a 2-hour visit, which has scarred me. I still talk about it 4 years later. So their hospitals typically have some other sources of revenue and the reason they go here as other revenue as opposed to non-operating income is because they are recurring and predictable sources of revenue, right? Whereas we'll come back to non-operating income in a minute, which is more of the kind of one-off kind of stuff. Okay, so this is our operating revenue section. So that's the top third of any income statement. The next section is your operating expenses, right? So relabel that. Operating expenses. So operating expenses, so this is, just a bunch of stuff that has to do with managing the different parts of the hospital. And this is how they have it organized. It's organized a little bit differently, right? There isn't like a supply expense here. Instead, they've got it aggregated based on service lines. This is some of the art of doing financial accounting. There's nothing wrong with doing it this way. As long as you capture all the expenses, and they are in fact operating expenses, it's okay to organize it by product line as opposed to by actual expenditure. So like if you look at this list, the thing that should glare at you is there's no line for salaries and benefits. So those are mixed into each of the respective services. That's okay. It does make it harder to do things like what's the, to compare how this organization is doing in terms of manpower expenses to another similar organization. Then we have the ones that you want to pay attention to are depreciation and interest expense, because those two come up a number of times later. Depreciation in particular, because it's a non-cash expense. Remember that? Right. This is, again, part of our accrual accounting process. And this is depreciation is how we capture the utilization of long-lived capital assets. Right? So we don't take the expense for the purchase of a building or of a very expensive piece of equipment like an MRI machine all in the year we buy it. We use depreciation, right, over the life of the asset to capture the economic value that's used in each year. So then we total all those operating expenses up, and the key here with operating expenses is these are expenses that are directly related to the generation of the income, of the revenue, of the operating revenue. So operating expenses should have something to do with operating revenue. Then we come to the third section, which they've just got as a single line, which is fine. This is an aggregated level income statement where they have non-operating income. So we had, I skipped a line. We have operating income, right? Operating income is operating revenue minus operating expenses. That gives us operating income, which we talked about. So this is, and we talked about that versus net income, right? Operating income is the income that we're earning from the core operations of the business. The business, so this is an important line because this is what management is primarily responsible for, right? We talked about on exam 1, I asked you about, should you fire the CEO question. I had a should you fire the CEO question. And it all rotated around differentiating between operating income and net income. And the difference between operating income and net income is non-operating income. Right? Non-operating income is going to be some of the expenses that aren't direct expenses and revenues or income that comes into the organization that is not directly related to providing services, the core services that the organization provides. So what's an example of non-operating income? Well, it'd be things like we had some property that we sold and we made a profit on that property for whatever reason. Maybe we had purchased land at some point and we decided we weren't going to use it for our organization, or maybe we had an old practice maybe that we decided to divest. So for example, Genesis, I think partly as a result of COVID, has been divesting, meaning they've been selling off some of their nursing homes that they manage. So I think it was your class, we had the long-term care folks come in, right? Had nods? Yeah, okay. And so a bunch of them were getting shuffled around as a result of the fact that the parent organization was selling off some of their buildings that they had that were probably not profitable. So they might, so Genesis, when they go to sell those buildings, will either have a gain or a loss as a result of the sale of the building. That would be a non-operating gain or loss, right? Because they're not in the business of buying and selling businesses. They're in the business of providing custodial and rehabilitative care to residents and patients. So that would be an example of non-operating gain or a non-operating gain or loss, to total out to non-operating income. So we add together operating income, non-operating income, and that gets us our net income. So that's a review of the income statement. I'm going to talk about the balance sheet now. So the balance sheet, right? We've got two halves of the balance sheet. The first half is assets. Right? Assets are the things, the resources that the organization uses to generate its revenues, right? So assets are the things that the organization uses to generate its revenues. And an asset, you know something is an asset if you can spend it, if you can touch it, right? Like the desk I'm sitting at, the computer that I'm talking to you through, right? If you can spend it, cash, if you can touch it, a physical asset, or if you can sell it in some way, shape, or form, then that thing is an asset. So the asset side of the balance sheet is organized into two parts. The first part is current assets. So the top section, right, of the balance sheet is the current assets. These are the liquid assets of the organization that the organization is going to use up or could use in short order. So, and typically the dividing line between being a current asset and a long-term asset is, do we remember what's the time frame between current asset and long-term asset? Anybody?
That if it can be used up in a fiscal year.
Exactly. It can be used in a year. So, so cash, for example, can be used immediately, right? Or it's expected, and then we have inventories, which would be like supplies, right? Those are expected to be used within, they're used up as you use them, they are expended and used up. So you may have some inventory that carries over from year to year, but you could conceivably, if you were going to use it, you would use it all up in that year. So at the top of the current assets is always cash, and cash Cash and equivalents. So this means literal physical cash that the hospital has sitting in the building, as well as cash that it has in its checking accounts. So when I was comptroller, CFO for a couple of hospitals, I had responsibility for cash management, physical cash in the organization. And, you know, and I, so like, the cafeteria, for example, runs on a cash basis. So people come in, they pay for their bagel with a $5 bill or whatever, and that cash ultimately has to go someplace. We had a safe in the building, and the people responsible for cash management would periodically make runs to the bank to deposit thousands of dollars in cash. So we had both physical cash as well as cash and checking accounts. Then you have short-term investments, which can be rapidly liquidated into cash. So that's an example would be like a CD at a bank, or short-term bonds held by the organization. So maybe a treasury bill held by the organization that in order to turn it into cash, you have to place an order, with your stockbroker to sell the bonds, and then you can get the cash, but it's not immediately in cash form. Accounts receivable, again, is that accrual basis accounting where we have sent out bills and we are waiting on payment of those bills. And this becomes an important measure later on when we get into days in accounts receivable. Inventories that talked about. So you add all that up, that gives you a sense of the liquidity of the organization. So how much liquid assets do they have to pay their bills on a day-to-day basis? Then we look at their long-term assets, and in this case, all they have listed is property, plant, and equipment. Well, they don't have property, but they have the plant and equipment listed here. So they have gross plant and equipment, which is the purchase price of the plant and equipment, and then the accumulated depreciation. So remember, on the balance sheet, the general rule is we carry everything at its purchase price. So when we purchase a new building for $100 million, that goes into this gross line of $100 million. And then at each year, when we get charged our depreciation, right, that accumulates over time. So if we've had the building for 10 years, each year we would charge depreciation for that building, and we would add that up. So whereas on the income statement it shows up just for the current year's depreciation, on the balance sheet we carry all the year's depreciation in prior years. And so if our building was $100 million and we had a 40-year life, let's say, it's 39, but 40 years, that would be $2.5 million per year in depreciation. If we had had the building for 10 years, we would have had $2.5 million per year over the course of 10 years. So our accumulated depreciation in this case would be $25 million, which is roughly what they have here, but I'm just making those numbers up, right? So then your net, if you had, in my example, if you had that $100 million minus the $25 million in accumulated depreciation, would give you $75 million in net property, plant, and equipment. In their case, they have $145 million in plants and equipment. So this is, they had purchased $145 million worth of buildings and equipment, and over time they've accumulated $25 million in depreciation. And so their net is 145 minus 25, gives them the 119. So we add then the net plant and equipment to the current assets to get the total assets for the organization. Now, this very simplified balance sheet doesn't include things like long-term financial investments. That would also be here. Financial investments, unlike everything else, the one thing that's not carried at its historical cost are financial investments. So those are adjusted year to year. But everything else is carried at its historical purchase price and then adjusted for inflation. Okay, so that's the asset side of the balance sheet. The liabilities and equity side is the other side. So I usually say liabilities and owner's equity, but it's liabilities and equity is fine. And then if this was a not-for-profit, which is the way they're, oh, hey. This is a not, so this is written as a not-for-profit, so it has net assets as opposed to owner's equity. So the balance sheet on the right side of the balance sheet, or the liabilities and owner's equity section of the balance sheet, is divided into 3 sections. So first you have 3 kind of big sections. The first 2 sections have to do with liabilities, right? And so you have current liabilities, which are the things like current assets. Current liabilities are the things that you're likely going to have to pay, or you are going to have to pay within a year. So they're the short-term liabilities. So what are examples of short-term liabilities? Well, accounts payable, right? So accounts payable is we buy something, we order something from our supplier, and our supplier sends us a bill and says, hey, here's your box of supplies, pay us within 30 days. So, so we know we owe them the $4,700, but we don't have to pay them within 30 days. So we have this account payable, which is an obligation to pay it, but we haven't paid it yet. When we do pay it, the account payable goes down, and then on our asset side, our cash also goes down. So organizations are constantly, like organizations like hospitals, are constantly ordering new supplies. Those supplies are coming in with a bill that's due usually sometime in the future and increasing the accounts payable. And then they're constantly paying down the accounts payable as those bills come due. And they manage that accounts payable to try to make sure that they have enough cash on hand at all times. So that accounts payable is always fluctuating. And it is what we talked about this before, it's called a stock variable, right? Where I use the bathtub metaphor to be the balance in the accounts payable is like the level of water in the tub, and you've got water coming in, which would represent new orders with new bills coming in and increasing your accounts payable. And then you imagine the water draining out, which would be the organization paying off its bills with cash. And so there's this kind of balance that's kind of constantly rising and falling depending on how fast they're ordering versus how fast they're paying off their bills. So that's true both of accounts payable as well as accrued expenses. The difference between accounts payable and accrued expenses, the way I think about it, and it's not critical to divide these things up. And sometimes you'll see on a balance sheet the 2 of these things listed together as one line. But the way I think of accounts payable is these are discrete transactions. I ordered $4,000 worth of supplies. Those supplies come in. You can draw very clear lines around that order. Accrued expenses, on the other hand, accrue over a period of time. So they're kind of flowing in continuously. So a good example of that, probably the best and most important example of that, is payroll, right? On any given day, you're continuously generating, accruing payroll expenses, right? Most of you who have jobs probably work on an hourly basis. Every hour you are at work, the business has accrued another hour of payroll expense, right? So that is a continuous kind of flow of expense coming into the organization or hitting the organization, as opposed to this discrete transaction of we ordered this box of supplies, we got the bill for this box of supplies, whereas manpower is just this kind of continuous flow of cost. Same with like utility bills, like electric bills. You're constantly using electricity. And so accrued expenses are when you draw kind of discrete lines around this flow. You say, all right, for the month of, where are we? December, we accrued some amount of expenses. When we pay the accrual off, it resets back to zero again, and then it keeps going. Where accrued expenses matter is when the payment period for the accrued expense flows over the end of a fiscal period. So, for example, if your pay period for, just say, the week you're working, Monday is 2 days before the end of the fiscal year, you're going to accrue 2 days worth of payroll expense. You won't actually pay it until the end of the week, but you've accrued 2 days, and so you report that here. So that's what that is, just a refresh. Notes payable are kind of short-term debt, and then we usually use the word note for that. Current portion of long-term debt, there's a note down here. That's the dollar amount of the long-term debt that matures or must be paid in the coming year. So this is if you have a car loan, right, where you've got a 5-year car loan, you're going to pay some portion of that. You're going to pay the principal, and that's what this is the principal only, not the interest, but the principal. So let's say you have a $5,000 loan, and you're in your first year. You're probably going to pay maybe $500 towards principal, and most of your payments are going to go towards interest. So for you, right, your $5,000 loan, the current portion of the long-term debt would be $500. And then down here under long-term debt, you would have the other $4,500. So this is the current portion, or the portion that you're going to pay this year. The long-term debt is the amount that you're going to carry over. So when you aggregate the two together, it gives you the full amount of debt obligations that the organization has. Again, all of this stuff in the top section, the total current liabilities, have to do with stuff that is going to be paid within the fiscal year. Then you have the long-term liabilities. We don't really call it that per se, but that's what it is. Well, they've got it here as broken out for long-term liabilities. Depending on the balance sheet, again, there's stylistic differences. You have the long-term debt, which I talked about. Capital lease obligations, which we will talk about in next semester, but they are treated essentially, is very much like debt. So you add those two things together, and that gives you your long-term liabilities, or total liabilities. So you'll add your long-term liabilities and your current liabilities to give your total liabilities. Then you have your equity, right? So your equity is how much, if this was a for-profit business, what portion of the business is owned by the investors? In this case, if it's a not-for-profit, what portion of this business is owned by the community, right? So the liabilities and owner's equity side is talking about are focused on the capital structure of the organization. And what do we mean by the capital structure of the organization? Really just means how much of the business is owned by the bank and other liability holders, and how much is owned by the investors. So our assets are all the stuff, right? And then, so on the left side of the balance sheet, or the asset portion of the balance sheet, captures the value of all the stuff the organization has. The right side of the balance sheet talks about how that stuff is financed. And so in this organization, we can kind of eyeball this very quickly and say the total claims on the assets, and notice that they're equal, right? 151 million in assets, 151 million in claims. 107 million of that 150 million is equity. So that means that the investors own 107 over 151, which is about 2/3, right? Without doing the actual math. So let's say 60%. So 60% of the organization is owned by the investors, and then the remaining 40% represented by the liabilities, the long-term and short-term liabilities, are claims by liability holders. So bond holders, banks, suppliers, and so forth. Okay. All right. The third statement that we worked on is the statement of cash flows. And I'm going to be a little faster with this one. The statement of cash flows is 3 sections. The first section, and let me stop first, back up. The statement of cash flows tries to reconcile the accrual-based accounting, where we are capturing the economic value of transactions as they happen, even though we haven't paid out the cash for it yet or haven't received the cash for it yet. So we reconcile that with the actual amount of cash that the organization has. And that's important because organizations have to really, really pay their bills in cash at some point. And so it's important to manage that amount of cash. Organizations that run out of cash go into bankruptcy. So it's really important not to have that happen. So the first section there are 3 sections in the statement of cash flows. The first section focuses on how much cash came in and went out of the organization as a result of operations. And we start with the operating income, right? We go back and we start with this line, the 108 million. Sorry, not the 108 million. This line, the operating income, 3340. Wrong slide. There we go. 3340, which is the operating income. I quoted the operating revenue, the operating income, right? And then we adjust that based on a bunch of mostly balance sheet changes, where things are changing on the balance sheet that are affecting cash, that represent changes that are coming about as a result of operations. So we had accounts receivable. That is, we're doing, if we have an increase in accounts receivable, what that means is we build out a bunch of stuff and didn't collect on it yet. So we've captured it as revenue, but it didn't come in as cash. And so if we had an increase in accounts receivable, where we are over counting the amount of cash that we have, because this increase in accounts receivable represents an increase in the accrued amount of obligations to us, but not the amount of cash actually collected. And so each of these things represents some effect as a result of changes in operations. And your textbook goes into this in detail, so I'm not going to spend a whole lot more on it, other than I want to make that one point. Remember, depreciation is a non-cash expense. It was counted in here as if it was a real cash expense, but we add it back, right, because the operating income is behaving or was accounted for as if it was a cash expense. We add it back to get a little closer to what our actual cash coming in was. So first section, cash flows from operating activities. Second section, cash flows from investing activities. And this primarily, when we talk about investing activities, we're primarily looking at cash coming and going as a result of buying new property, plant, and equipment, so that's this first line, as well as moving cash in and out of investments, in financial investments. And so that's this section. So, and again, it's not income that we're dealing with, right? It's important to remember the purpose of this statement is not to capture income per se. It's to capture how much cash moved inside the organization and where, how it came about. So investing activities, if we bought new property, plant, equipment, we had to spend cash to do that. If we moved cash from our checking account into short-term securities so that we would earn more interest, well, it's not that we lost money, it's just that we moved it from being liquid cash to slightly less liquid cash. And so we move it out of being cash into something else. And so that's the investing section. And then the third section is financing. One of the things, and so with financing, we put our non-operating income in financing because that typically represents a big chunk of non-operating income has to do with changes in the way we finance the organization. So if we pay back bonds or loans, that is a decrease in the amount of cash that we have on hand. And then if we were to take what's not here for, but is a useful example, is if we bought a new piece of equipment. So let's say we go back here and we say we bought $4,200 worth of new equipment. It would be a negative over here under investing, but under financing, if we finance that, so we'd have a negative cash flow because we bought new equipment. But if we financed it, we would have an equal positive increase as a result of financing. So if we took out a loan for $4,200 to buy the equipment, when we bought the equipment, it would our cash would go down. But in the financing section, we would see a positive increase because we took out a new loan that gave us new cash. Now, the two things would be a wash. Over here, you'd see plus 4,200, and over here, you see minus 4,200. But that's part of the game of trying to track the cash status. And so we add up the effects of the three sections. We take the 5,900, the 6,200, and the 500, add those together, and they net out to 832. Then we go to the balance sheet. And for the prior year, our starting cash was $50.95, right? So that's where this comes from. The $50.95 is last year's ending cash. We add to it, in this case, and add a negative 832. So we subtract 832 from the 50.95, and that gives us our ending cash of 42.63, which if you go back to the balance sheet, you can see is the starting cash, ending cash for 2015. So they ended the year with 50.95. They had cash flows, overall cash flows of negative 832. And that had them end their cash balance at 42. And so this is what I'm trying to show you is the connection between the two statements, right? Is this line here, the cash and cash equivalents. Okay, so that is the statement of cash flows. They go into some details here about what they did. I think we've covered that enough in detail. So I want to start talking about ratio analysis. So that was kind of meant to be our rehash of stuff you learned earlier in chapters 3 and 4, which you will need to do the rest of this material. So we talked a little bit about this in chapters 3 and 4 about using ratios. Why do we use ratios? Well, because it allows us, it gives us a number that we can compare where absolute numbers are difficult to make sense of. And so it gives us a number that we can compare across time. So for example, our operating margin, which is our operating income divided by our operating revenue. So we know we can compare over time in a more meaningful way. If we say our operating margin last year was 4% and our operating margin this year was 3%, we can compare that. If you said, well, our operating income is 4,000 and operating income this year was 3,500. Well, we know it went down, but how significant is that? How are we doing relative to our expenses and revenues? It's useful to have these ratios, and then it's useful, then we can also compare them to other organizations, where if we said, well, our operating income is 4,000 and your operating income is 6,000, are we doing worse than you or better than you? That's kind of a meaningless comparison. It's more meaningful to say, because that organization might be a little bit bigger than us, right? And so it's more meaningful to say, our operating income was 4%, your operating income was 2.5%. We're doing better than you because we're able to more readily convert revenues into income than you can. So that's why we use ratios, and we've talked about that a little bit. Financial ratio analysis often mixes together values from different statements that allow us to, again, the main point here is, well, 2 points. One is they're significant, right? They tell us something meaningful. And 2 is they then allow us to do comparisons, either year over year to ourselves, so comparing ourselves to ourselves over time, or comparing ourselves to some benchmark, either that benchmark being either an industry standard or a group of like competitors, so organizations that are similar to us. Okay, so the point here in this slide is, for me to tell you, say our total profit margin is 7.3%. What does that tell you? Is that good? Is it bad? I don't know, right? It by itself, it doesn't tell me anything other than it's 7.3%. So I don't know if if the organization earns 7.3%, is that good or bad? I don't know. So we need to engage either in trend analysis, which is what I was just describing, which is we're going to compare ourselves to ourselves over time. So if this year the margin was 7.3% and last year it was 8%, that tells us we're decreasing. So that would be concerning, right? Or if we said the alternative would be comparative analysis, which means that we compare to another organization or we compare to a benchmark. So if the benchmark is 6%, 7.3% tells us that we're doing well, right? If the benchmark is 10% and our organization earns 7.3%, that tells us that we have a problem potentially. So some general categories of ratio analysis include profitability, right? Looking at how, is the organization earning profits? Is it doing what it's supposed to do, right? Generating enough profit, either to satisfy investors, if it's a for-profit entity, or earning enough profit to allow for reinvestment and expansion of the mission, if it's a not-for-profit. So profitability measures are important. Next is liquidity, right? And these are things like days cash on hand, how many days of expenses do we have on hand, current ratio, which we talked about in chapter 4, which is the relative ratio of current expenses to current assets. Debt management, which we also talked about in chapter 4, at least a piece of it, which is like the debt ratio, like how in debt is your organization? And we're concerned about that because the more in debt an organization is, the less flexibility it has, and the more financial leverage it has, which we'll talk about more next semester. But the key thing to remember here is if you've got a lot of debt, you are going to have a correspondingly large amount of interest payments. And those interest payments have to be made regardless of how your organization is doing in terms of profitability. So the more debt you carry, the riskier your organization is. And then asset management. How efficient is this organization relative to its peers in terms of providing goods and services using a fixed amount of, or its given amount of assets? Let me just Sorry, didn't want you to have to listen to me blow my nose. Okay, so there's kind of these four broad categories of financial ratios. So we'll look first at profitability ratios, and these are both. This is review for us. We talked about both of these in chapter 3, and here he's using the author is using. This is really profit margin. But now calling it total margin. So in chapter 17, when we say total margin, we're really saying profit margin. Profit margin is right. The overall, remember this from chapter 3, is the overall amount of income brought in relative to the overall amount of revenue earned. That total revenue is 117. So let's real quick go back and look at that. Right, total. We had operating revenue of 112, but then we had non-operating income of 5. So to get our total revenue, we're adding the operating revenue and the non-operating revenue, and that gets us up to the 117. And we take that net income, that bottom line number of 8,500, and divide it by the 117, we come up with 7.3%. The operating margin, right, focuses just on the operating portion of the income statement. And so we're taking the operating income, 3.3 million in this case, and dividing it by the operating revenue of 112 million. And so we have a significant difference between the operating margin and the total margin. And one of the things we talked about was, which one of these is more important? And the point I wanted to drive home for you, or then I want you to remember here, is operating margin is what management is truly responsible for, right? This comes as a result of the operations of the organization, and that's what we hire our managers to do. Total margin includes that non-operating income, and that non-operating income very often, and we looked at this in some real financial statements like Wentworth Douglas and Exeter Hospital, right, where they had gains from their investments that inflated their net income, and so they wound up with higher profit margins in many years than they had operating margins, because the market happened to be doing well, right? And so you want to look at both of these because they both matter. The fact that Wentworth Douglas has additional resources to provide care to its patients is important to know, even though that money came from investments, right? It's important to know that, but it's important to remember that fact, that the organization's operations are not completely funding all of its revenues. Some of it is coming from investments, right? So this gap is common. It's typical for profit margin or total margin to be greater than operating margin. But total margin is going to fluctuate a lot more year to year because it's unpredictable about how investments are going to do. Also in here might be the organization has to pay a significant lawsuit, right? That would drive down total margin. So you might have a healthier operating margin and a negative profit margin. Those are both of these are profitability ratios, and we often think of them as measures of expense control, because the difference between total revenue and net income is expenses, right? Is total expenses. So if you can shrink your expenses, your net income is going to increase with the same amount of total revenue. So if we had total revenue of 117, what was our expenses? They were 108. So if we were able to shrink our expenses, if we were able to shrink our expenses from 108 to say 105, our net income would have gone from 8.5 to say 11.5, and we would have a much higher total margin. So one of the ways to look at these two ratios is to think of them as measures of expense control, as we assume that the numerator in both cases would be larger because the difference between the numerator and the denominator is the amount of expenses that the organization is paying. So often this is used as a measure of expense control. So in that sense, this, particularly the operating margin, tells you how effective is management at managing expenses. So we've done those two. Two that I'm not sure, I don't think we covered these. We had the information to do it. We didn't really talk about it. So return on assets is a way of measuring the amount of, is basically, let me think. It is saying, managers, here's a bunch of stuff, right? That's your assets. We're going to give you $150 million worth of stuff. Go make us some money. And so at the end of the year, the managers come back and say, owners, investors, you gave me $150 million worth of stuff to work with. Here is $8.5 million back that I have earned for you, right? And so it's looking at the ratio of the income to the assets that were used to generate the income. And so again, this is one of those situations where what's better? Well, bigger is better, right? So we want a bigger ROA. Now, the ROE is actually what investors care about the most. ROE is the return on equity. So this is, this measures the return, the amount of income that is coming in and is owned by, or coming in as a result of the amount of investment that the investors have made. So the equity is the amount of money that the investors actually have at stake. So remember when we looked at, right, we looked at the balance sheet, we said, well, they've got $150 million worth of stuff, right? This is all the stuff that the organization is using to generate income. Then we looked at the liabilities and owner's equity section, and we said, how is that stuff, right? How is all that stuff financed? Well, in this case, roughly what we said was roughly 2/3, maybe 60% is financed by the investor's own cash, right, in the organization. And the other third to 40% is funded by liability holders, whether that's loans in the form of debt or loans in the form of suppliers letting us buy stuff on credit. These are all, so about 1/3 of our organization is funded by borrowing, and 2/3 is funded by investors giving the organization money. So the investors care about their return on the amount of money that they have at risk in the organization. Because if you're an investor, right, so let's go back down here. If you're an investor and you've got $1 million, you could, if you give that money to this organization, the management is saying, we can earn you 8% on your $1 million. And you say, if you know anything about investing, that's actually a pretty good return, especially in the last 10 years or so. You can't take your $1 million and put it in a savings account, right, and earn 8%. You're going to earn like 0.25%. You can't take your money and put it into a government bond, even a long-term government bond. You're going to earn like 2 or 3%. So as an investor, you're saying, where do I have this $1 million? I want to put it someplace so that it earns a return for me. This organization earns 8% on equity. I'm excited about that because that's a lot more than I can earn by putting the money into a government bond or something like that. And so this is the return to the investors. This is a return to the overall assets. Now, the investors care about that, but they care about this more, right? ROE is the gold standard for measuring return to investors, right? So the investors care a great deal about the return to their investments because if you have a low ROE or they think you will have a low ROE, they're going to want to take their money out of the investment and put it someplace else. So if there's a hospital that earns 12 or an investment that earns 12% return on equity, investors might be interested in putting their investment there instead of here. And we'll get into some of the adjustments for risk next semester. But let's assume for now that both of these investments have the same level of risk. Investors, if you're looking at two investments and one has an 8% ROE and one has a 12% ROE, you're going to want to put your money in the 12% ROE. Now, if you're an investor in a firm like this, it might not be that easy to get out of it. And so if you're an investor in say a hospital and it's a for-profit hospital, you're looking at this number and saying, you're only earning 8% and the hospital in the next town is earning 12%. And now you're the investor talking to management. You might say, you know what, management, if you can't figure out how to get up to 12% like the hospital next door does, you need to get your resume cleaned up because we're going to be looking for a replacement for you. Right. So that's what this measures, right? So key difference here is ROA, kind of big picture, how are we doing with respect to all of the resources that we have? ROE is is a measure of return to what the investors actually have at risk. And that's what they really, really care about. So now we're going to look at comparing this organization to itself over time, as well as an industry standard. So this is total margin, operating margins, profit margin, in other words, profit margin, operating margin, ROA, and ROE. So how do we look at this and make sense of this now? Well, we did a little bit of this in chapters 3 and 4. Total margin in 2014 was 2.2%. Total margin in 15 was 7.3%. So comparing itself to itself over time, right? It's doing much better. It's about tripled its total margin. The industry standard is 5%. So we could compare itself to itself over time. We can also compare it to the industry standard. So in 14, it was below the industry standard. In 15, it's above the industry standard. So that's good news, right? We go down, we look at operating margin, kind of the same story. Well, I guess in this case, operating margin is below industry standard, even though it's improving slightly. So that would be a concern to me as a board member, right, or an investor. And say, well, okay, good, your total margin's up and it's up above industry standard, but maybe it's only up because you had that non-operating income that you, management, didn't have that much influence over to begin with. So I'm not sure I really want to give you a particularly good bonus this year because you're still not hitting industry standard. Now we can look at ROA and we can say kind of similar things. And again, because ROA and ROE are based on, really are based on net income, which is that total margin. You want to be a little bit hesitant and say, okay, how's the return on overall assets? Pretty good. Both it's improving and it's better than the industry average in 2015. How about ROE? Well, maybe not so good. And here's an example of where we could, and we'll talk about this some more in a minute, or maybe next time, where we could leverage, so this is a phrase that is used in finance, we could leverage this organization more. This organization has, and we'll get to the financing ratios here in a minute, this organization has roughly 2/3 of its assets financed with equity. If you could drive down the amount of equity and keep the same amount of net income, then you would have a higher ROE, right? If this number was smaller, if we made the denominator smaller, then the ratio would go up. So if I change this from 107 to say 60, you'd have 8/60 as opposed to 8/107. And so this number would be more like 16% as opposed to 8%. Investors like that. The way you would do that is you would refinance the organization and have it be more financed with debt. In other words, you would leverage the organization by increasing the amount of debt it takes on. That could make the ROE go up, but that is a risky thing to do. That's a risky thing to do because, wrong slide, because when we take on more debt, we take on more interest payments, and so it's a risky, this is a risky thing we're doing. So that's all things you have to keep in mind, which is why it's useful to have multiple points of view. So you could talk about ROE, but if you're not also talking about the financing ratios in terms of how much debt the organization is taking on, you can get you could be misled about how well the organization is doing. All right, so we have these comparisons. So I'm going to move on to the next one. So the next section is liquidity ratios. So we've been talking about profitability. Now we're talking about liquidity. Liquidity really gets at how well prepared is the organization to pay its short-term obligations. And so the two big ones for that are the current ratio, CR, current ratio, and the days cash on hand. So we've talked about current ratio before, and we did that in chapter 4, where we take the current assets, right, and they're divided by the current liabilities. So the current assets are the resources that we have that we could readily convert into cash, or we expect to have available to us to use in the current year. So for this organization, that's 31 million. And then the current liabilities, right, are those things that we know we're going to have to pay within the year. And so in this case, that's the 13 million. So we divide current assets by current liabilities, and we're looking for a number, right? That number 2.3, bigger is better. All other things equal, bigger is better because it tells us we have more capability of paying. We have more assets to cover our liabilities. Days cash on hand is something we have not talked about. It's a funky formula, so you're going to want to pay attention to this formula and make sure you understand how to calculate it. Days cash on hand is probably one of the most important ratios that managers pay attention to. And what it basically says is, if revenues stopped coming in, but our expenses continued, how many days could we run the organization? How many days could we pay for the expenses of running the organization with the cash that we have on hand, right? The cash we have available to us. And so to get that, to calculate that, we take the cash plus short-term investments with the idea that short-term investments can be liquidated like overnight. So they're kind of like cash, but not, technically not. So we put that in the numerator to say, okay, these are the resources we have. And then we take our cash expenses and divide it by 365. So our cash expenses, in this case, our total expenses for the operating expenses for the year were 108 million, but we want the cash expenses. So we add back depreciation or subtract depreciation because that's not a cash expense. So depreciation was included in that 108 million, but it's not really it's not at all a cash expense. And so our real cash expenses is 104 million per year. That's in thousands. So 104 million per year. So if we're really spending 104 million per year, we divide that by 365 days, and that gives us our cost per day to operate our organization. So we get $287,000 per day, right? And we take 4.2 million in cash plus 2 million in investments, divide that by the 287 per day, and that gives us 21 days cash on hand. Most not-for-profit hospitals have somewhere in the vicinity of 80 days cash on hand, because they don't just include their short-term investments, they also add on, and this is not in this textbook, they also add on not obligated long-term investments. Remember, a lot of not-for-profits have this big war chest of long-term investments. And sometimes those are obligated to pay for things like bonds, bond payments. But if it's not obligated, then that also gets added into the numerator. For our textbook, they're focused on kind of this pure days cash on hand, which is truly just cash plus short-term investments. But I want you to know that when we look at this industry ratio, this is not what most not-for-profits are looking at. They're not looking at this kind of purest days cash on hand. They're looking at a version of this where you also have long-term investments, right, added on. So you want to keep that in mind, and so that you have to pay attention to what organizations are actually talking about. So current ratio, that's true. It's about 2.3, about 2. So this organization has an improving current ratio, but they're really low on days cash on hand, right? It's gotten a little bit better from 14 to 15, but it's really low relative to the industry standard. And so that would be a matter of significant concern. The Lakes Region Hospital, and I'll stop on this because I see we're at time. Lakes Region Hospital, LRGH, up in Laconia, was running at like 12 days cash on hand at one point. Even with that war chest thing calculated in there, they'd burned through all their cash, and they have gone into bankruptcy, which is sad because it's run by a friend of mine. So again, we're comparing ourself to ourself over time, and then ourself to the industry average, and you want to do both of those. All right, so we'll stop there. We'll wrap up the rest of these ratios next time. Do get signed up in a work group for your final exam sooner than later. I would advise, make sure you pick your team carefully because this is a group grade. So pick somebody that you know is going to be responsible. Do read this chapter and take notes, because if you don't understand these ratios, I'm going to give you a quick explanation of it, but I'm going to be expecting you to understand it and work with it. And I'm not going to just be like, oh, give me that number. I'm going to be expecting you to be like, I'm going to say something like, tell me what this means, right? And if you the formula is simple, it's just a plug and chug, right? but the understand you need to get to a point of understanding. So you don't have to memorize these things. Even if we were doing this in person, I wouldn't make you memorize it. But you have to be able to interpret it. That's the important part of the ratio analysis. Right. So I will hang on here. Have a great rest of the day.